Joining me now, President of Bianco Research, Jim Bianco. Jim, I want your societal take on this whole battle between Robinhood traders and hedge funds as you see it.
I think your introduction was well put. You had a lot of the issues that went there. Following the breaking of the pound, and long-term capital came after that, and all the way through the financial crisis, I think what happened on Wall Street, to be very blunt about it, was a lot of collusion. A lot of these firms start all knowing what they're doing. They don't attack each other. Remember long-term capital in 1998. When they ran into trouble, it was the other hedge funds that smelled blood in the water and went after them. Today, if there's blood in the water by one of their counterparts, they bail them out, as we saw last week. So they left the street enormously exposed. And I think the retail investors, through the Reddit chat rooms and everything else, saw that and used it as an opportunity and seized on it. And from here on forward, I think the business practices of Wall Street are going to have to start to change. There's a new player in town, let's call it the outsider, and the outsider is going to look at what they're doing, and if they expose themselves to risks, they will take advantage of it.
So to your point, I think it's fascinating. We just got this breaking news, $2.4 billion, Iconics, Sequoia, and Andreessen, the same names, right? The same names that always get a bite at the apple when these companies are going through mezzanine funding, series 1, 2, 3. They've come to the rescue again. So it's $3.4 billion in the last 48 hours of trading or so. Are they taking a stand, or in your mind, can we see the time to maybe hedge funds don't always win?
No, I think we're already there. I think you saw it with the great reduction of the short interest in GameStop that was reported today by S3 Partners and the other ones that track it. They're capitulating right now on this loss. We've seen this throughout the last year. Remember when Buffett sold the airlines and they got mad, and it was Dave Portnoy who kind of led the charge, and that the airlines doubled the month after that, and then they bought the work-from-home stocks that aren't part of the indices, that all the fund managers said were overvalued. They ran Tesla up 600%, and eventually it was included in the S&P 500. These retail investors, I know everybody comes out and says, be careful, be careful, be careful. I think it's the professional investor that has to be careful, because these retail investors keep eating their lunch, and they just keep winning and winning. That's not going to happen forever, but right now, they're the top of the mountain. It's not these hedge funds. It's not the professional investor. They're the ones that are on the losing end of this trade.
I got less than a minute. Should there be any changes with the ability to short more than 100% of a company's float, or even curbing what's said on chat rooms?
Curbing what's said on chat rooms is very dangerous. I'd be very dead set against that. Shorting, the SEC was invented in 1933 because of shorting abuses in the 1929 crash. They should do their job. They should stop abusive short practices. And I think that that is probably one of the problems here. Yeah, maybe GameStop was undervalued, but this, quote, gamma squeeze, because everybody was massively short, that's on the hedge funds. They were so arrogant, thinking no one's going to stop us with this, and we found somebody. Those are the practices on the institutional side that really need the scrutiny. That's what set up the vulnerability. The other side is just capitalism. Yeah. They saw an opportunity and took advantage.
Jim, all I can say is amen, brother. Thank you very much, Jim Bianco.